Welcome back to our weekly update. I'm Charlotte McLeod with investingnews.com, and we're going to run through a few of this week's biggest stories in the mining industry. If you enjoy this video, don't forget to hit the like button, subscribe to our channel, or leave us a comment below. Let's get into it. Gold dropped significantly on August 5th as global markets faced volatility, sinking as low as the $23.75 per ounce mark after closing the previous week around $24.40. Diverse factors were at play that day. A weaker than expected U.S. jobs report released on August 2nd stoked fears about a recession in the country, with only 114,000 jobs added for the month of July, compared to the 175,000 expected by analysts. However, the Bank of Japan's interest rate hike has been widely identified as the bigger culprit for the sell-off seen on August 5th. The central bank surprised market watchers by raising rates to 0.25% on July 31st, the highest level in a decade and a half. It also left the door open to further increases in 2024. Why did that move from the Bank of Japan spark a market meltdown? Experts are pointing to the yen carry trade, a strategy that involves borrowing money in a place where rates are low and using it to generate returns in a place where rates are higher. Japan's years of near-zero rates have made it a popular destination to borrow money, and investors have been able to use those funds to make gains in lucrative areas, for example, U.S. tech stocks. While that might sound like a simple way to profit, carry trades tend to involve high amounts of leverage, making them potentially very risky. That risk element is what played out this week. The value of the Japanese yen was already on the rise ahead of the Bank of Japan's rate hike, and that boost pushed it even higher, spooking those involved in carry trades around the world. The question now is whether global stock market chaos is over or just beginning. While major U.S. indexes have shown signs of recovery, a JP Morgan Chase global FX strategist told Bloomberg the unwind is only 50 to 60% complete. Gold was back above 2,400 as the week drew to a close. I heard this week from Peter Grandich of Peter Grandich & Company, who said that while he's out of uranium after taking profits early in the year, he now sees 5,000 as a legitimate long-term price target for gold. Here's how he explained it.
I'll tell you what has changed since we last spoke. I never thought of this. I was always the guy that stood at a show and say, yes, I'm bullish on gold, but to talk about 5,000 gold or $10,000 gold, I think that's foolish. You shouldn't. Not foolish anymore. There's legitimate possibilities for those type of numbers to be reached, certainly within a matter of a couple of years, because of all the things and other things that we didn't discuss in this thing. So I'm also think that the upside could be greater now than any other time in my career.
When asked whether he'll ever get back into uranium in the future, Peter said it's possible, but for now the sector isn't undervalued enough for him. I'll leave the link to the full interview with Peter in the video description, and I also encourage you to check out this week's interviews with Will Rind and Brett Heath. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.